Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka, and joining me from the studios is my colleague Yatin Mota. Well, Yatin, we started on a very strong note. Of course, historic reforms in terms of the GST rate rejig was announced last night, and clearly we saw it play out in the morning. But completely fizzled out. 280 points shaved off from the day's high. Nifty just about barely managing to end in the green. The mid cap index also ended the day in the red. So all the cheer that we saw at the start completely fizzled out. Of course, the likes of autos, FMCG, they were seeing good traction, but even they, came off quite significantly from the day's high. In fact, so many sectors ended the day in the red. The likes of metals, pharma as well. Gave up all of those gains. PSU banks as well came off. They were showing good traction off late, but today, of course, came under selling pressure. The realty pack was also down somewhere around 0.8%. The Nifty Bank Index as well completely flattened out. We saw good traction on the Nifty Bank Index yesterday, and one would have thought that it would continue, and it did continue. But along with what happened in the market, all these sectors came under profit booking. We'll get an expert to understand, what really things are looking like going forward. But yeah, then broader end of the markets, there as well, the advanced decline ratio also turned in favor of laggards today. And that's
Yeah,
something that was not happening over the last few
correct.
sessions. But today, all the momentum that we
Yeah.
saw completely fizzled out.
Fizzled out, and if you look at the advanced decline ratio, almost was 2 is to 3, and the mid cap index from the day's high was down 1,000 points. It ended in the red, lower by nearly 400 points. Small cap index also down by 125 points. And barring the auto and FMCG counters, most of the sectoral indices ended in the red. So the market breadth was extremely weak. The GST cut, which was much awaited, was on expected lines. Probably the market used the opportunity to sell on rallies. Today was a unexpected low volume, a low action day versus the market expectation that today would be a good day to trade, a good day to really accumulate stocks, but that didn't work out. And most of the stocks which opened gap up, probably in the metals pack, in the insurance pack, or probably in the auto pack, the rallies were sold into.
Of course, the rallies were sold into, and that's what really played out today. But without any further delay, let me bring on board the big market voice that we had promised. Pankaj Tibrewal, founder and CIO at IKIGAI Asset Manager. Pankaj, lovely chatting with you after a long time. And a lot has transpired, really. A lot of good headlines. Let's focus on the positives. In terms of tax cuts in the budget, you had good GDP data, inflation also under control. We had the S&P upgrade as well. And now, of course, the historic GST reforms. So there's no dearth of good news, but it seems like the market is refusing to focus on the good, and perhaps they're focusing in more on FIR sell-off and the tariff tantrums that Trump is playing. Because all of these good news, the markets did see a pop, but kind of fizzled out. Same thing that happened today. But going forward, what would you expect in the near term? And of course, these reforms, GST reforms in particular, are they expected to have like a multiplier effect over the medium to long term? What are your initial thoughts?
So thank you, Nandita, for having me on your show. The first one, let's talk about the recent one, which is GST. I think GST rationalization is a very significant reform step, if you ask me, in terms of compliance, in terms of making sure volumes improve. And if you look at from an overall perspective, we believe that there are certain segments in consumption which has a very high price elasticity, mainly durables and autos. So if you look at the last 20-year data, I think in consumer durables, you have an elasticity of 1.5 to 2 in many years also. And similarly in auto, if you remember, in 2008, for a temporary time being, we reduced the excise duty by 4 percentage points for a limited time period. But you saw 20% CAGR in volume growth across all the automobile segments. So there is a significant elasticity which probably is there. And hence our belief is that should be good from an overall perspective. And from the messaging, if you look at for the last three events which have taken place by the government and the RBI, all are pro-consumer. First the tax rate cuts, then the interest rate reduction, and then now the GST reform, giving more money in the hands of final the end consumer is a welcome step. And we believe that finally, after 5 years of capex stocks being outperforming, there could be a a reasonable thought process that consumption can make a comeback, which had been a very big laggard. And within consumption, we
Hmm.
believe consumer discretionary should do well. So from that perspective, we believe that GST is a very important step. And the US tariff, which is a very significant headwind, our understanding as a house view is that government will release more reform measures as you move ahead into the next 2 months. Even assuming some part of tariff remains, wherever it is, I think a large part of reform can take care of that headwind. So we are not so
Hmm.
overall negative on the markets. Yes, markets have consolidated over the last 12 months. Now, 3, 4, 5 months, we believe further could be consolidation phase. But overall, we believe that the rate of incremental change is not turning out now negative, it's turning out to be positive. I was at the conference across last 2 weeks, meeting my counterparts both locally and globally. The mood is
Hmm.
of pessimism right now on the street. So I think that's a very good starting point from that perspective that markets have given up. Markets are not expecting anything big happening, but our sense is that starting third quarter onwards, December quarter, I think you should see a significant pickup in earnings led by banks, consumption, NBFCs, and so on and so forth. And the easing policy should start aiding back to the growth path. So I think broadly speaking, I think we believe that markets in the near term could be sideways, but somewhere post the December quarter result starts coming out, I think markets can find a reasonable space upwards from here on.
Right. Pankaj, this is Yatin also joining in from the studios into the
I
conversation. When you talk about the markets today, obviously we had a sharp intraday fall. If you look at sectors like auto, probably FMCG, stroke consumption, white goods, there is a direct 10% benefit to the consumers. However, when you talk about sectors like cement or probably insurance or for that matter, several other sectors like defense, the GST exemption, the GST changes, or the input tax treatment probably increases the cost. How do you look at those sectors? Because the market-wide expectation was that there could be a significant amount of revenue loss to the government, say 1.5 lakh crore. Yesterday, the finance ministry said that the revenue loss would be about 40,000 crores given the fact that the GST has been rationalized. So, do you think the GST cut or the structure was expected to be much better, which didn't turn out, and hence the sell off in the market?
Not really, Yatin. I think markets post the 15th August announcements had seen significant rally in the sectors where they thought the GST rationalization should happen. So you saw a very significant rally in auto stocks, auto OEMs across two-wheelers, four-wheelers, except M&M. You saw that happening in consumer durables. So I think it was more of buy the rumors, sell the news, and some profit taking which happened. I won't read too much into this. I believe, on the contrary, that the GST rationalization is better than my expectation or our house expectation at least. The kind of number of consumer goods which have been brought into the 5%, and many of them have been brought to nil. I think we didn't expect so much of wide coverage. And I think that's a very welcoming step. And overall, we believe that there could be a 0.4 to 0.5% impetus on the GDP on this side because of better consumption growth rates as you move ahead. So
Hmm.
whatever headwinds probably that tariff would have given about 4 to 0.5% on our GDP, I think that a part of that could be negated from the consumption upswing. And second is also inflation will be lower because of the GST tax reduction. And I think that both should bode well from a macroeconomic stability perspective. And from a fiscal perspective, I don't think that there will be a huge loss to the government. The sin tax in certain things have been rationalized out there. And overall, I believe that even if for 1 or 2 years, even if we need to expand our fisc, we are okay. The reason is that for the last 4 years post COVID, India is the only large economy in the world which has consolidated its fiscal account from 7-8% of central GDP to now about 4.5% of
Mm.
GDP. And please don't forget that every point of consolidation is at the expense of growth. Now, when the world is
Hmm.
struggling for growth, there's geopolitical tension. Even if you need to maybe 20, 30 basis points of fiscal stimulus to the economy from a growth perspective where there is a headwind on tariff issue, I think government should be open towards that. And that's what we are seeing, that government is pushing through tax rate cuts. You saw that in RBI, the pro-growth policy. You saw now being followed up by GST rationalization. And my hope is more structural reforms would find its way over the next few months, whether it be on the
Hmm.
land, labor, productivity, cost of production, everything I think we should address and don't waste this crisis which is there in front of us.
Hmm. Pankaj, there's one thing that I want to draw your attention to, and that's private capex, because that's been missing, right? Because the government has done everything in its power to revive consumption. Experts I spoke to said there is no need, no reason for private capex to not step up now. Do you think that missing piece of the jigsaw puzzle will now fructify? Do you think that will happen? And as a result of that, should one look at industrials at all now?
So, Nandita, I don't think there is a massive slowdown as what people are pointing out. The data suggests otherwise. So, we were looking at the FY25 annual report numbers of the top 500 companies of India. And last year, their capex spend was about 8 lakh crore plus. And overall, if you take the listed and non-listed space, it's about 11.5 to 12 lakh crores. And this number few years back was about 5.5 lakh crores. So over the last few years, I think we have made significant progress. Obviously, some demand stimulus will make sure that the incremental capex also starts to move up. What we would desire is that the spread of the capex should be quite wide. Today, we look at the top 10, 15 industrial groups and few PSUs who are doing bulk of this 8 lakh crores of capex in the NSE 500. And once that spread starts to widen, I think that will be the real momentum which the economy is waiting for. Our sense is that in many areas that has started to happen, whether it be electronic manufacturing, you are seeing the entire new energy ecosystem being developed on renewables, on transmission, on semiconductor, and that's all what we have not invested in for last many decades, and it's a completely new area of investments. So earlier, the traditional areas used to be steel, cement, thermal power plants, and some few other industries. But now many new industries are also taking the capex heavy
Hmm.
burden, and I am quite optimistic that over the next 2 3 years, the capex cycle on the private sector should also be doing reasonably well. Now, from a stock market perspective, our sense is that incremental change is happening positive more on consumption rather than capex because government
Hmm.
capex has been slowing down. So we need to be very clear that many stocks in this space are not cheap. And last 4 years, they have been the best performing stocks or sectors, if you say, whether it be on the renewal side, whether it be on the power side, anything related to power side. So the longer term theme remains. But in the near term, we believe that the direction could be and portfolio adjustment should be done from capex to consumption themes and other few sectors where we have a completely contrarian view, where we believe that there is reasonable opportunity. One is commodities, and we believe that in this last 2 3 months correction, if you look at first time after many years, the commodity stocks actually made new highs rather than correction. So many steel names, many non-ferrous names have actually made new highs, which shows that market is sensing something different. And when we look at the global macro, I think there are two important things which are happening. One, we believe that structurally inflation is going to be higher for longer as people and countries build supply chain more near them. And second is that the China anti-deflation policy which they have started for the last few months, and they are rationalizing capacities across the board. So in the last 2 months, if you look at coking coal is up 50%, polysilicon is up 50-60%, so is iron ore and steel prices. So I think clearly market is sensing something different, and hence we believe that commodities could be an alpha idea as you move ahead, which includes cement as well. So cement plus metal names are, I think, a completely contrarian call. And the third sector where we believe that the worst phase is behind us is chemicals. So last 3 years, you saw the worst downfall in the last 20 years in the global chemical sector post-COVID. And I think that is coming to an end with destocking getting over. And bulk chemicals, where China used to be the major player, again, the same rationalization of capacities has started to happen. And we believe at the lower end, at the bulk chemical space and the specialty chemicals, the prices are not no longer being falling as it was in the last couple of years. So when I look at the space, I think there are good opportunities where we can see compounding of earnings growth over the next couple of years. And that's the three sectors where we believe metals, cement, and chemicals, which are completely contrarian, out of box thoughts, and the other, normal sectors where we believe, portfolio should be positioned is consumption, auto and auto ancillaries. We are underweight IT, but at some point, IT has also started to look reasonably valued when we look at the free cash yield and the dividend yields now on the IT stocks. And one indicator which we track is the global CEO confidence index. It's at the lowest in the last many years. And whenever it hits the lowest point, from there, the next 12 months, IT sector tends to generate very good alpha because only thing which happens is the improvement in the confidence index on the CEO side. And this is a global CEO indicator confidence index which we track. So I think IT has started to look reasonably okay. And there are reasonable valuations on IT sector. But from a longer term perspective, Indian IT services have their own trouble. It will be more of a tactical opportunity on the IT sector rather than a longer term theme.
Right. Pankaj, one question which comes to my mind is, the impossible trinity in the global markets, a lot of ifs and buts, a lot of uncertainty in the shorter term at least. On one hand, we have GST cut, income tax cut, probably we have the rate cut also moving very faster than anticipated as inflation worries are behind us at the domestic market. But on the other hand, we have a depreciating currency, we have uncertainty in the global markets, as you were mentioning that the CEO confidence levels are low. When it comes to UK or probably France, they are talking about IMF bailouts with their domestic yields moving at all-time high. In the local market also, we have seen, the rate transmission getting hampered probably because we have the bond yields in India also rising. So, in a scenario wherein we have equal number of positives, equal number of negatives, and over and above that, we have auto companies which will have to take a hit on inventory which is already sitting. We have a lot of consumer and white good companies which will have to adjust their pricing on old inventory which is already sitting in the system. Probably that means that next 2-3 quarters, probably we cannot see a very huge uptick in corporate earnings. However, demand would be there. They would be able to clear their inventories. In such a scenario, do you think next 2-3 quarters will be challenging in terms of the market range, earnings range, and probably the kind of capex decision that the corporates take globally?
Very valid points, Yatin. I think as a market practitioners, every day there's so much of noise in the market, and how to take those calls, I think is a very, although points which you made it a very valid points. But over the last 2+ decades, what at least our learning has been, that there are certain things which are beyond your pay grade. So don't stress too much about those things. For example, what will Modi and Trump do? What will be the tariff 50%, 80%, 20%? All these, I don't think
Exactly.
anybody has an answer to, right? What we can do is that cut out the noise and see where is the earnings growth going to be in the 500, 700 stocks universe. Where are the best 30, 40 names which could be part of our portfolio. And I think that what really matters over a period of time. And more than that, I think in today's market, what is important, Yatin, is how to also avoid landmines. I think as the growth overall and last few quarters have started to slow down, we have seen many landmines starting to emerge. And when capital raising will become a little more difficult, I believe many balance sheets and cash flows which have thrived only on capital raise over the last 2, 3 years will find it tough to please the market again from a growth perspective. So we need to be making sure that we do what we are good at and not worry about too much of noises, which is probably at least our strength is not there in focusing on those noises. Uh, but one thing which we believe is that the rate of incremental change from here on is going to be positive. What are those rate of change? You have already seen a 50% impact on tariff. Market is worried. Can he move to 100, or can he move, or if there's a some kind of a midway arrangement, as Mr. Piyush Goyal mentioned, in by November or fall of this year, can there be a some kind of a understanding which can happen? That's a rate of change which could be positive, not negative. Earnings growth, single digit earnings growth for large cap. From third quarter onwards, post this disruption in the next 1 to 2 months, can the earnings growth starts to look better than what we have seen over the last 2, 3 quarters? Our assumption will be yes. So that's the second rate of incremental change. The third is that we have underperformed MSCI by 24% in the last 1 year. This is the highest amount of underperformance we have seen over the last 15 years. Can the rate of change be positive that regional markets which have been outperforming us, probably some money starts to move into back to India as markets correct itself or sideways movement for a while and earnings starts to start again looking up? Answer is yes. So when I look at the
Hmm.
incremental change per se, I don't think you are seeing at a big correction in the markets, despite of FI selling off such a huge amount, about 16, $17 billion this calendar year to date. We have seen markets where it is. I'm just thinking about over the next couple of months, if further reforms happen, earnings outlook starts to improve, FI flow starts to happen. Will you get this market at this, or the stock prices at this level? Our answer will be probably no. So I think when you look ahead over the next 1, 2 years, I think this is good that a correction and a consolidation phase is happening in the market after long. 12 months have gone by, maybe 3, 4, 5 months more because of different kinds of headwinds which you mentioned should be good for the health of the markets. And finally, when companies will deliver earnings growth, you will see stock prices reacting. One thing which we have learned, finally, stocks are nothing but slave of earnings. And over
Hmm.
the last 25 years, market returns resemble the EPS growth of companies. So finally, EPS growth is there, markets will reward that. And our sense is third quarter onwards, you should see a decent earnings growth starting to kick in.
All right, third quarter onwards, you can see earnings growth, likely to pick up. But last question really, Pankaj. I was just reading some reports wherein they said that there could be household savings to the tune of almost 2 trillion rupees, right, as a result of the GST rate cuts. But would you say that all of that will get channeled into consumption, or would you say some of it will still find the way into capital markets?
So it will be a mixed one, Nandita. I think the household leverage is also very high right now. So I think
Hmm.
a part of the savings, if people kind of have it, they will use that part to deleverage their balance sheets as well, personal and household balance sheets. So I think leverage as a system will also start to come down is our call, and a part will flow into different discretionary consumption basket. And wherever there's elasticity, you will see more people upgrading or new buyers coming into that category. So I think broadly speaking, it will be a combination. And I think capital markets is a structural, up move in India, which we are seeing. We have 20 crore demat accounts now, which used to be 4, 5 crores few years back. I think as more and more awareness happens about equity market, bond market, you will see this financial awareness being there, and that's the biggest challenge for banks, right? because the CASA, which used to be the low cost deposit, which used to be the bread and butter for most of the banks, now nobody wants to keep balances in bank. They try to move it into liquid funds, arbitrage funds, or maybe other funds on equity side or debt side, and nobody wants to keep a balance where only 3-4% is the rate of interest which they get. So I think these are structural, moves which are happening in the economy, and we should be cognizant of those facts. I think today pessimism in the market is huge. I can only tell you across nobody is expecting anything, and today's market move also to a certain extent, shows that despite of this, some maybe because front ending had happened already post the 15th August announcement, but expectation is very low in the market, and any
Hmm.
incremental positive change, either on FIs coming back into the market, earnings growth picking up, more reforms on the government, any trade settlement on the tariff side. Tomorrow, Mr. Trump's wake up and say that India is my best friend. See what will happen to the markets. So I'm just saying that these are
And it's
things.
quite possible, Mr. Trump might do that.
Yeah. So you never know.
You
So I
can't really
think.
predict.
That's what, and our sense is that this is the great time to do research on companies. Market is giving you that time and opportunity, and I think that's what we are doing. In the next 2-3 months, I think market could be sideways, stock pickers
Hmm.
market, and then once earnings growth comes in, market will find its own levels.
Lovely, lovely thoughts, Pankaj. You're not sounding very pessimistic, and that's a great thing, really, because there has been a fair bit of pessimism in the market ever since that whole Trump tantrum really started. But
Absolutely.
it was lovely chatting with you, Pankaj,
Thank you.
and I
Thank
look
you.
forward to
Thank
more conversations. I have a lot of questions with me even now, but I'll save it for some other day. But I would like to
thank you.
thank you for
Thank you,
taking out
Yatin.
time
Thank you,
and have a
Nandita.
great
Thank you.
evening.
Thank you.
Thank you.
Thank you.
Thank you.
Well, on that note, with that, it's a goodbye from me and Yatin. Thanks a lot for tuning in. Of course, tomorrow is a new day. Hopefully, we'll regain some lost momentum. But let's see. But before I sign out, here is a message for our viewers. Introducing Money Control Super Pro, your ultimate investment superpower. Get live calls, trading, and investment ideas from SEBI registered experts, pre identified chart patterns, and AI powered stock alerts on WhatsApp to help you trade and invest with confidence. Super Pro, where serious investors stay ahead. Download the Money Control app and subscribe to Super Pro today.